Good evening. Welcome along to the Squirrel Investor webinar. We do this about 3 times a year. We give you the opportunity to hear a bit from me on some things going on in the market and with Squirrel. Then you'll have the opportunity to do some Q&A. So our agenda for today is a brief update on what's going on in the residential housing market. We'll talk a bit about cybersecurity and some of the new features coming soon to the Squirrel platform. I'll give you a brief overview of the portfolio performance for Squirrel and a bit of a spotlight on our home loan term investments. Last but not least, we'll finish with a Q&A. You can ask me anything related to Squirrel and I'll do my darndest to give you a great answer. It'll take about 20 minutes for us to run through the bits that I've got to present, and then you're welcome to stay on for the Q&A and ask questions, or you're welcome to leave as we go. We are recording today's session and we'll post a YouTube video probably in about a week's time, which stitches together the questions that we had from this afternoon's session and this evening's session, so you can see what others asked and see the answers that I had for them. All right, let's get moving. So starting with the residential housing market, 2 graphs here from a recent ANZ economics pack. The graph on the left shows the month-on-month movement in the REINZ house price index, okay? So when you see bars below the line, that means house prices are falling. Bars above the line means house prices are rising. The fact that the most recent month shows an increase in the index, I wouldn't read too much into that. I think we're at the bottom, and so we're probably going to see the lines bounce up and down a little and be a little volatile over the next wee while. I don't think we're going to see any particular movement in house prices until we start seeing interest rates actually start coming down. The correlation between interest rates and house prices is reasonably strong. So I'd suggest, at least for the remainder of this year, they're just going to bobble about a bit. You'll see a bit of up, maybe the occasional month down as we go. Graph on the right is more of a forward-looking indicator. So also using the REINZ house price index, and the Barfoot and Thompson auction clearance rate. So it's a weekly percentage of the houses sold at auction, advanced 4 months. So they've pushed the line forward 4 months, and you can see that there's a pretty neat correlation there between movements in the auction clearance rates and where house prices move. So at the moment, ANZ's forecasting house prices to be broadly flat over the next 12 months. The auction clearance rate suggests that they're going to rise a bit. I suspect I'd probably fall personally more in the camp of ANZ, that we're not going to see any consequential increases in prices, certainly not while interest rates are where they are. But hey, stranger things have happened, and if you've got a crystal ball that you want to lend to me, I'm happy to take it. Moving right along. Next 2 graphs are from Centrix. So Centrix are a credit reporting agency in New Zealand. They hold data on most Kiwis and also many Kiwi businesses. So this particular set of information is home loan arrears on the left and personal loan and buy now, pay later arrears on the right. So if you look back over the last 6 years, back to 2017, you can see that traditionally, home loan arrears rates have been higher than what they've been for the last 3 years. So we went through the COVID period where actually most people did pretty well, managed their finances pretty well, and we saw arrears rates at actually historically quite low levels. You can see that the arrears rate has actually bobbed up to about 1.3%. And if you look back over that last 6-year period, prior to COVID, that's about the low point of where the arrears rates get to. I think what we're seeing right now is households adjusting to inflation and adjusting to interest rates being high. So you're going to see a bit of up, bit of down as those households go through that belt tightening exercise. Graph on the right looks at personal loan and buy now, pay later arrears. What you can see is that personal loan arrears and the buy now, pay later have both been at historically quite high levels over that 6-year period, perhaps starting to come off their tops. And I would suggest same again, as inflation's been eating away, people are going to tighten their belts. So that belt tightening exercise, Kiwis haven't really had to do for a long, long time because interest rates have been falling for the best part of 30 years. So Really, this is the longest, most sustained period of rapid interest rate increases we've had for an awfully long time. So that adjustment process might take longer than what you might expect if you were having to do it on a more regular basis. Supporting both of these two things, though, is the unemployment rate. So everyone, if you want a job, there's pretty much jobs out there. If you're not going to be too picky about what you want, you can probably get employed tomorrow. So there are plenty of jobs about. And while that unemployment rate stays where it is, for those that need to adjust their circumstances, they'll be looking for other jobs, taking on a second job, or maybe one of the partners in a relationship might be going back to work, those sorts of things. So people are finding ways to make ends meet, particularly with such a buoyant job market, or relatively buoyant job market. All right, so there's a bit of an update on the residential housing market. So a bit more about Squirrel. So a couple of things from us. First of all, some of our investors will have seen an email from us a couple of weeks ago relating to anti-money laundering and updating your investment intentions. So from that email, we had quite a large number of responses from people saying, hey, is this a scam? We're a bit worried about this email in different ways, shapes and forms. And with hindsight, the way we'd written the email, that could feel that way. And I think that's probably amplified by the TV series starring Nigel Latter, which looked at scams and digital scams in the market. So people were rightly a bit wary. And we're going to adapt our own behavior as a consequence of the feedback that we've had from investors. So no longer will you see us asking you to click a link to log in from our emails. We may still have links in our emails, but they'll be to our website, or they'll be to perhaps YouTube for, if you want to watch back a webinar like this once we've posted it. But we won't be asking you to log in from our emails any longer. And we appreciate that can be a little less convenient, but the best thing you can do is go to your browser, search www.squirrel.co.nz and log in from there. Second point on the page, multi-factor authentication option is coming soon. In fact, we went with a release into production today for our staff. So we're going to be trialing this ourselves for the next 2, 3, 4 weeks, make sure that it's fit for purpose and ready for customers or for yourselves. So watch out in September. You're likely to see us starting to talk about the option for you to turn on multi-factor authentication. Last but not least, I think one of the most important cybersecurity actions that Squirrel takes is that we have, I'll describe it as one way in and one way out. So we hold a bank account that we expect money to come in from for your investor account. And when you make a withdrawal, it's going to go back to that same bank account. We think that's a nice, strong protection, both for you and for Squirrel, to try and make sure that money arrives the right way and ends up back in the right bank account with you. So, yeah, 3 different things there that we're doing in that cybersecurity space to help keep you safe and help keep us safe along the way. A few other things on our product roadmap. So we're expecting to deliver multiple on-call accounts for you. So that'll give you the option to open more than one. At the moment, we know some of our investors are a bit frustrated because we only have one on-call account available for our investors. So keep an eye out. I would say in the next 2, 3, 4 months, you'll see us launch the ability to have more than one on-call account, so you can bucket your money effectively. Second point is auto reinvesting. We know that that's quite a convenient feature and quite a large number of our investors use it. However, now that the on-call account pays interest, we're seeing some investors saying, oh, actually, I want to keep some of my cash liquid. I want to earn that nice return, but I don't want to see my money swept into it. And in another term investment, I actually need to keep some of it liquid. So we're thinking quite hard about a simple way to allow you to store money in an on-call account, but also have auto reinvestment turned on to make sure your money's working hard for you. Third point, we will also introduce the ability for you to invest with a portfolio mindset. So we know there's a good chunk of our investors who have some of their money spread across either 2 or 3 of our term investment portfolios, so home loans, construction loans, and personal loans. At the moment, it's quite hard to keep a balanced portfolio. So if you wanted to say 50% in home loans, 30% in construction loans and 20% in personal loans. That's quite hard to achieve and it requires you to manually do work. We'll be introducing a feature that allows you to actually bucket that money up and auto reinvest it, which will try and keep your portfolio roughly in proportion over time. We're also looking at a higher risk option for wholesale investors. So if you're a wholesale investor and you qualify under the rules that are published by the FMA in that space, so perhaps you know a lot about investment, you've got a decent whack of money, you're prepared to take risk. If you're interested in a higher risk option, then the best thing you can do is drop an email through to me, dave@squirrel.co.nz. We don't have the option available particularly today, but we're happy to start taking a bit of a register of people who are interested. And once that product launches, we'll make that available to the relevant people. Last but not least, we know over half of our investors use our mobile apps, which work really well for them. Although I would say they're starting to get relatively old in the scheme of things. They're quite expensive to maintain, and we're looking at options to improve that mobile experience for our investors. I've had those apps in place for about 7 years now. So looking to improve on what we do. So yeah, keep an eye out for that. That probably won't land until after Christmas, but something we're also thinking about in the background. So there's a good list of things we're considering. If you have product features or ideas that you'd be interested in seeing, don't be afraid to let me know, dave@squirrel.co.nz. Just drop me an email through. Happily receive ideas from you. All right, let's keep moving. Onto some portfolio information for you. So this gives you a sense of some of the data, A, that's on our website, and B, some of the things you may not know. So first of all, this month, we're likely to reach 5,000 active investors in our portfolio. So thank you. We appreciate it. Thanks for being investors with us. And we think that's a bit of a milestone for us to reach 5,000 over time. Next point, we've got 116 million of loans that are supported by our investors through our term investments. And on top of that, Squirrel's got about another 15 million of loans in stock. So when you go to place an investment order, you may see that there's not necessarily a lot on the market at the time to be picked up. Don't worry, lots of home loans and construction loans available in stock for you. From a personal loans perspective, we don't hold any loans in stock. As soon as they're available, they get gobbled up by investors who have joined that investment queue. Those queues have actually got quite long recently. We have seen a little more activity and a few more loans starting to settle in that personal loan space. We had our biggest month since actually October last month. So there is a bit more activity there. However, those queues are still relatively long, so it's going to take you a wee while to get invested. And as a reminder, while your money's waiting in the queue to get invested, you're still earning our great on-call rate of 5.25% per annum. Speaking of on-call accounts, we've added a new little widget to our website, which shows you the balance of the money held in the Squirrel on-call accounts. I took the snapshot yesterday, 74.5 million in there at close of business on Sunday night. So there you go. A little more portfolio information for you now. This is, you'll also find on the marketplace page of our website. You'll see the size of the portfolio that is supported by investors. So it's the leftmost column in this table. So you can see personal loans, active number of loans is 13.1 million. Home loans, nearly 19 million, and construction loans, 73 million when I took this snapshot yesterday. Those numbers do change. Even during the course of the day, you'll see them move around. So it's quite an active thing. Next column, I think, is really important for investors in managing investment risk. So you can see the size of each of the reserve funds supporting the investment classes there. You can see the construction loan reserve fund tipped over $1 million just towards the end of last month. So great to see that first one tip over that point. Next column I'll point out is the second in from the right, which is the expected borrower default rate. So this gives you an indication of the amount of risk in the portfolio. You can see personal loans at 0.87%, construction loans at 0.39%, and home loans all the way down there at just 0.04%, which is a very, very low level of risk, and we believe a very conservative style investment as a consequence of that. On the far right, gives you a sense of the amount of money that we're reserving into each reserve fund. You can see that those numbers are comfortably ahead of the amount of risk that is in each of those portfolios. And we think we're reserving prudently into those reserve funds. This information is updated regularly on the website on the Marketplace tab. So if you go and hunt that down in the Save and Invest menu, have a look in there, scroll down the page, you can see that. And just below this table on the website, there's also a link which looks into default rates and arrears rates and all those sorts of things. So if you want extra for experts, dive in there. There's a huge amount of data on our personal loan portfolio, our home loan and construction loan portfolios as well. Alrighty. So this is the last slide that I have before we move into our Q&A session. You can start jotting your questions in the Q&A box, and I'll pick those up once I've finished this slide and start talking through them. So spotlight on home loan term investments. As I mentioned before, I believe it's a very conservative investment option, and here's some of the reasons why. So first of all, if I work my way down the page on the left-hand side, if we look at the type of borrowers in that portfolio, these are borrowers that banks don't do a good job of looking after, but genuinely actually are relatively low-risk borrowers. So an example might be someone who's 55 to 60, they want some flexibility with their loan. They might want to go to interest only for a 2 or 3 period while they're renovating the family home before they downsize. That would be a common example. So people like that, banks find quite difficult to deal with for a range of reasons, when in reality, they tend to have a lot of equity in their property. They've got a very clear project, a very clear exit in, 1, 2, 3 years, and banks just struggle to work with them. So one of the segments that we've built this home loan product for supports that group of people. So if you move to the next point, it talks about the loan to value ratio. So that's the amount of debt that someone has relative to the value of the property. So if it's $1 million property and they've got, let's say, $600,000 of debt on that property, that would give you a 60% LVR. Now, funnily enough, over time, around 60% LVR seems to be the sweet spot for the type of borrowers and the segments that we're working with. At the moment, the portfolio is actually lower than that. It's at a 48.5% LVR on the active loans in that portfolio today. Next point down, measured credit risk is 4 basis points on the active loans in the portfolio, which I mentioned in that table on the page prior. Over time, it's averaged 10 basis points, and you can see that demonstrated in the graph top right. What we show there is the construction loan portfolio and the home loan portfolio and the amount of credit risk in each of those portfolios. I put the construction loans in there just so you've got some comparison for home loans. So you can see home loans is actually a very low level. You can see the construction loans, the risk was higher going back in time. We've actually dialed down the amount of risk that we're taking about 15 months ago. And you can see that having flowed through into the portfolio. The dotted lines there are a 12 months rolling average of the data. So you can see that we're trending down to lower levels of risk in both of those portfolios at present. For home loans, we've not had a default. We've got no loans in arrears, and we've had the occasional loan go over term. I mentioned before when I was talking about the types of borrowers that often it's project-based, so they need some flexibility for 6 months, a year, 2 or 3 years. And at that point, then the loan gets paid back. Occasionally, some of those projects don't quite complete on time. So we have a loan that might run over term for a month or two. In that time, they're still making their payments. So there's actually nothing particularly wrong. They are paying default interest, which goes into the reserve fund in that situation. And those loans recover. We keep a very close watch on them. We're in touch with the borrowers on a regular basis, and we'll support them as required. The graph at the bottom right shows you the arrears, which you can see we've not had a loan go into 30 days arrears. We've had 3 loans go over term over time. And we've never had a loan go into hardship. Now, hardship's a technical term that's allowed for under the CCCFA legislation for a borrower who perhaps loses their job or gets into an awkward financial position and needs some relief for a short period of time. Okay, Another thing to protect you is the reserve fund. So that home loan reserve fund's got over $200,000 in it, which should be ample to deal with any risks that come through in the portfolio, as we expect today. However, no one can look into that crystal ball and tell me exactly what's going to happen tomorrow. At the moment, that reserve fund is in good shape with over $200,000 in it, and at 4 basis points of credit risk, it will happily gobble up any issues that roll through. Last but not least, our investors are earning 7% per annum for this investment, and they also have the ability to sell via the secondary market and create liquidity for themselves. So when you add all of those points together, I believe that this is the best risk-adjusted return that you'll find in the market. 7% for this type of investment risk is a fantastic outcome, in my opinion, for investors. But, I would say that, wouldn't I? All righty. So that's a bit of an overview of our home loan term investments. And perhaps at the next webinar, I do about 3 of these a year. Perhaps I'll cover the construction loans or the personal loans in a bit more detail. All righty. Moving on, we'll get to our Q&A. So I can see there's a couple of Q&As there, so I can start diving straight into there. Don't be afraid. Ask me anything related to Squirrel, and I'll do my best to answer those questions. All right, question from Martin. Partial sell. Will there be a way to partially sell our peer-to-peer investments? Yep, that's one of the features I didn't talk about, but something that we're absolutely thinking about. So I'd expect you'll see something on that sometime between now and Christmas. So that's, for example, if you've placed a $10,000 term investment, but you only want to exit 5,000 of that, you'll be able to sell just 5,000. So absolutely, we've had investor feedback around that, and we'll be looking to do that sometime in the next 3 to 6 months. So keep an eye out for that one, Martin. Next question from Steve. Lots of recent news about emerging bankruptcies in the construction sector. How are our reserves getting on to cover this growing risk? So construction loan fund, reserve fund is going really well, just over $1 million in there today. There are, I think, 2 loans in the portfolio that are over term at the moment. Maybe it's one or 2, so not very many. And there are no loans that are 30 days in arrears. I think there might have been one that missed a payment yesterday, but I expect that it'll be caught up in the next few days without any particular issues. So the portfolio is actually in very good health at the moment. Nothing in arrears, 30 days plus. 2 loans over term, which I expect will close out in the next few days. And they've only been over term for maybe a week. So nothing particularly concerning there. You mentioned liquidations in the market and bankruptcies. So we've not had any of our loans for any of our building companies go into liquidation, or the underlying companies go into liquidation. We have had one default in the portfolio that happened at the beginning of this year, and that's the first and only default in the portfolio. If we look at how much we've lent now, so we're about 330 million lent on construction loans life to date in the portfolio, and one default has rolled through. So at this point in the cycle, things look pretty good. We're starting to see investors who have been sitting on unsold stock of properties. We're seeing those houses starting to sell through. So at this stage, we're continuing to be cautious. We're watching pretty closely. Probably the other thing I'll mention in the construction loan space. So in May last year, so what's that, about 15 months ago, we dialed down our risk appetite a little, and we saw the amount of credit risk. So if you look at the amount of credit risk that we're taking in that construction loan portfolio, which is in the top graph on this slide, the blue line measures the amount of risk in the construction loan portfolio. And I put that one in there so you contrast home loans with construction loans. So if you go back to sort of May 22, we started dialing down the amount of risk in the portfolio, and you can see that started to roll through. So if you look at the 12-month moving average, which is the dotted grey line there, you can see that's run down, getting pretty close to 40 basis points worth of credit risk. Lots more A and B grade borrowers with security rated at 1 or 2, which typically means the properties in good saleable locations and metropolitan areas. So yeah, portfolio is in really good health. There's lots of information that we keep up to date on our website about the portfolio. You can go and check on the bottom right graph is published on the website. There's another similar graph for the construction loans, which shows where we've been over time. And yeah, we want to be really transparent with how the portfolios are performing. So use that page on the website and it'll give you a really good overview. So Steve, a really long answer to that question. Hopefully I touched on the points you were hoping for us to get at. If you have follow-up questions, please do ask. Alrighty ho. Question from Glenn. How are you implementing AML and CDD compliance, requesting supporting information for each large transaction or against your personal account valid for a period of time? We're primarily looking at you answering questions on what you expect your behavior to be over time. Our investors are answering those questions. We don't expect to collect it off you often, but if we spot an anomaly between what you've told us and behavior, then it's likely you may get a phone call or an email from us just checking in on how things are going and seeing if we need to adjust the settings that we hold for your particular account. Anti-money laundering is an important area. The reason for doing it is twofold. So first of all, it's a good thing for all financiers to do to try and prevent money laundering going on. We don't want nefarious criminals undermining our financial system. And the second reason is obviously there's a regulatory requirement for us to do so. Thanks, Glenn. Hopefully that's answered your question there. Next one from Anne-Marie. Good, you are reviewing the daily sweep on the full account amount. Yes, thanks for that feedback, Anne-Marie. We know that's a bugbear for some investors today. And I expect that you'll see that resolved over the next 3 to 6 months. What conditions lead you to the higher arrears in 2017? What are on-call accounts and doing wholesale investments have a risk rating? All right, so let's 3 different questions there. I'll pick those off one at a time for you, Jill. Higher arrears in 2017. So for the home loans back in, if we go 2017 through 2020, that was probably the tail end of the GFC rolling through. So we saw, post the GFC, we saw arrears rates pick up for homeowners. In fact, you saw it pretty much across the market for debt holders. And then over time, people recovered their positions. So you saw a slightly falling trend in arrears for homeowners. And then COVID rolled around, people weren't spending money, interest rates dropped. And so most homeowners with loans were in pretty rude health through that period, certainly from a financial perspective. So you saw arrears rates drop quite a long way. And so what you see now is them normalize and getting back to where you'd expect to see them over a long period of time. Another way of looking at that is default rates. So if we look at effectively borrowers that have ended up in a mortgagee sale position at a market level, and the Reserve Bank publishes data on that, we saw that from about 2017, 2018, right through till last year, the amount of money that banks were writing off in relation to home loans was incredibly low. And to put that in perspective, it was 4 to 5 million on outstanding loans of 350 billion. Okay, so that's down at sort of 0.001% of a portfolio, which is incredibly low. In the most recent Reserve Bank data, we did see it pop up a little bit. So it was up at 8 million. Once again, still 350 billion of home loans. So nothing to be concerned about, particularly there at this point. We'll keep an eye on that. And maybe at our next webinar, I can show you some information on that one. You can find it on the Reserve Bank website if you're prepared to go digging and dig through some spreadsheets. There was another question there, wasn't there, around what's the on-call account? So on-call account is the account that money lands in when you first make a deposit with Squirrel. So that's your on-call account. We're looking at giving investors the opportunity to have more than one of those. Last question from Jill was wholesale investments, do they have a risk rating? This is something we're thinking about. We'll think about the way that we explain the risk to investors. Key thing though is that you probably are going to need to meet the wholesale investor criteria. So the Financial Markets Authority publishes a criteria around what constitutes a wholesale investor. And as a good citizen, Squirrel really wants to make sure that people who may enter a portfolio like that do understand the risks that may exist within that portfolio. So that's something that we're thinking about. I have another question that's just popped in, so I'll answer that one from Donald. So what would be the advantage of having more than one call account? The requests from investors that we've seen, they might be holding money on call for different purposes. So they might have money that they're using to invest longer term, and they want to be able to set up auto reinvest. If auto reinvest is turned on, it's going to sweep that money all the time. So if they were looking to hold some money in cash that was available to them very quickly, then that doesn't work well for them. So we're seeing investors wanting to have a couple of different buckets, so that perhaps they can put the holiday fund that they're going to use next month, they can hold in cash in a separate account, but they can still have auto reinvest turned on for their longer term investments. So that's an example of having multiple accounts. Most people will only have one, or they might have perhaps 2 or 3, but we're not expecting people to have more than, let's say, 3, 4, 5. So that's the feedback that we've had over time. Thanks for that, Donald. Another question's popped up from Chris. What do you mean by sweep the money? So if you have auto reinvest turned on, so you'll see that option pop up when you're placing an order on the platform. If you turn that on, let's say you've got $5,000 in your on-call account. At 9 o'clock that night, when we go and check for auto reinvest, if you've got more than $100, we'll sweep that money into a new investment for you. So let's say you're investing in home loans. At 9 o'clock that night, we'll go check. If you've got more than $100 in your on-call account, that money will be swept into a new investment, which will start that evening, assuming there are funds available or loans available for you to invest in, which there should be for home loans and construction loans all the time. For personal loans, for those of you who have been around a while, will know that you will need to join the queue, so to speak, in order for you to get invested before. All right. First question is from Mark. What's the credit rating of the institution you place on-call funds? That credit rating, Mark, is AA-, so it's one of the main 4 banks in New Zealand. We tend not to discuss who it is for no particular reason, and you'll find that others in a similar position will do the same thing. So yeah, AA- rated bank. Next question is, how's the Squirrel Monthly Income Fund performing? Great question. So Squirrel Monthly Income Fund takes funds in and invests them into Squirrel's term investments. It's got a bit in home loan term investments, a little bit in construction loan term investments, and the remainder in the personal loan term investments. So overall, that fund is returning 7.10% or thereabouts for investors per annum. Those returns are paid on a monthly basis, and you can choose to capitalize them or have that return paid out to you. So yeah, the fund's performing well for investors, and that track record's starting to build up now. The fund's been operating for probably about 20 months, give or take. Thanks for that question. Moving on. Raphael, just wanted to thank you for hosting the webinar. Appreciate your work. Thanks. Well, there you go. That's an easy one to answer. Appreciate you joining in to the webinar. Righto, that brings us to the end of questions that are in there. I'm just going to talk for another 30 seconds to see if something else pops up. I did mention earlier that this webinar has been recorded. We'll stitch together the questions that were asked this morning with the questions that have been asked this evening, so you can see what everyone's talked about. So thank you very much for your time. Looks like that might be the end. Julia, thanks for your thank you there. Very good. Thanks, team. That's the end of the webinar. I hope you've enjoyed it. If you have other questions, don't be afraid to reach out to me on dave@squirrel.co.nz, and I'll get any questions that you have answered. Thanks very much. Catch you later.